What's up, people? Welcome back to a new episode of Kickoff Sessions. Welcome to the 39th episode, and welcome to the second episode that is now on YouTube. Yes, I made the move to YouTube last week for my 38th episode. It was about time to make that transition, so here I am. Hopefully, this will give you a bit of indication, some clips, some podcasts, a bit of background from my guests as well. So, just to complement Spotify and Apple Podcasts. Which brings us to our conversation today, which is with Daniel Mauro. Episode 39 is all focused around financial markets, whether it's traditional markets, Bitcoin, commodities, looking at these different areas from a fundamental perspective. Dan first received his degree in physics and nuclear engineering at West Point, which is the United States Military Academy, in 1998. He served in the US Army for over 4 years before moving into financial markets. He then got his master's degree in finance, which he's then applied in all things financial markets. Daniel has also traded extensively in equities, commodities, and future markets. The topic of conversation today is all around financial markets, whether it's bond yields, interest rates, and how these can affect normal equities, growth stocks, or quote unquote stonks as well, and the impact that this can have at the moment and in the future on markets. We also take a look at different markets, including commodities markets, as well as looking at cryptocurrencies, and specifically looking at Bitcoin, looking at its fundamentals, and getting Dan's insights and perspectives. With all the experience Daniel has, this is hugely valuable for myself and for the traditional retail investor to get a bit of an understanding, a bit of a background, and just to learn a bit more along the way. So before we get going to launch my second episode on YouTube, if you could subscribe, that would be awesome. If you want to leave a comment and just give me some thoughts, that would also be great. So I'll leave it right here. Here is my podcast with Daniel Mauro. Perfect. Daniel, how are you doing?
Do well, Darren.
Thank you very much for agreeing to the call. I really appreciate it. As I mentioned before, long follower of your LinkedIn profile. I think you LinkedIn 1 and LinkedIn 2.
So yes. I called Elon Musk followers lemmings, and they gave me the boot. I had to start all over.
you got shadow banned, literally in the age of being shadow banned. You were literally, because it's funny because we were chatting and then all of a sudden it got deleted and I was like, what the fuck is going on here? But yeah, basically we found time anyway to set this up.
Yeah, it's funny. Some people they're all also connected with my wife, and they messaged her like, "What happened to Dan?" So I was like, "No, he's still here." So
he's still like.
Yeah, I got back on, and starting to get things rolling again. So
nice, yeah. So basic purpose of today is just talk about kind of all things markets, whether it's regular traditional markets or in Bitcoin, all the kind of crypto space at the moment. With your experience, it's valuable for someone like myself who's young, who's just in that kind of retail investor space, especially amongst many other people that are my age. So before we get going, can you give a short background of where you got to where you are at the moment, especially from coming from the military into working as like a portfolio manager at the moment?
Yeah, I went to West Point, which is the military academy in America for the Army. I studied physics and nuclear engineering. I had really no idea what I wanted to do as a career, beyond the military, and physics just seemed like a good challenge. So I did it, but by the time I was done, I knew I did not want to be a physicist. I mean, that I was sure. So I graduated in '98, and I became a lieutenant. And first time I actually started, earning a paycheck. My dad had always been in the financial industry, but I had never really shown any interest in it. I mean, I was aware of what he was up to, but it wasn't something I ever really saw myself getting into. But he just recommended, you should read this one book called The Great Crash about 1929, written by John Kenneth Galbraith. It's a classic of financial history. And I read that book in 1998, and I just started reading, and after a year, I was hooked. I mean, I knew that's what I wanted to do. So I got out of the military in 2002, and when I got back to Chicago, that's where I'm from, I started working at an option firm at the CBOE, a market making company, and then I also I moved to another one at the Merc, both trading S&P 500 index options. And I found it very instructive as far as to see the real mechanics, of how markets function. But option market making is a very narrow slice of finance. And just from an intellectual curiosity standpoint, I didn't really feel it was fulfilling. So like I said, I'm glad I did it, but I was, I didn't, it's one of those things. Monday morning came around, I'm like, damn, I gotta go back to work. I mean, that's not, that was not, nobody wants to be in that situation. So, like I said, my father, was in the industry, and he had been a stockbroker, option trader, hedge fund manager, and then he had started this Registered Investment Advisor, which is just basically a long only stock, bond, maybe some option writing type money management business. And he started in 1996. So this is 2004. He said, at this point, it's getting too big for me to run by myself. So if you're interested, it'd be great if you can, it makes sense for you to come on board at this point. And, I talk with him a lot about markets, and the investment side was just seemed much more fascinating to me than what I was doing with the option market making. But before I joined, because I had only had a physics education, he said you should go to school and get some basic finance. So University of Illinois, I was able to get a scholarship to go there for 1 year to do a master's degree in finance. So it's like half of an MBA. None of the marketing or operations aspect. It was just purely finance. So that was just a good 101. And started working with him in 2005. And then I started actually managing client portfolios in 2007. And we started off when I first joined the firm, we were about 18 million, and now we're up to about 170. And so it's been a good run. And I tell you what, it's, like I said earlier about how when I was with the option trading firm, I didn't want to go to work. Like now, I can't wait. Like I almost don't like the weekends because the stock market's not open. So anybody listening, you can find, if you can find a situation like that, I mean, I think that's more important than money. I know. So
I completely agree with you, because that's very much kind of similar where I walked into, because as I said, I had a background in tech, and now I'm kind of moving more into finance, and I way more gravitate towards it. And even just, could be reading the release of earnings are coming out, or what's coming around on a weekly update. It could be like the Fed's announcements. These things just interest me and just give me a good, I don't know, they kind of just satisfy what I'm kind of looking for, which is really interesting. You mentioned you're in the army. Do you think there's anything that you learned there that was really fundamental towards you, understanding markets, whether it's discipline or having patience, some of those learnings, because not many people come from the military into these types of careers. So you must have obviously had an edge in a certain type of way.
I think there's probably 4 things I learned in the military, and 3 of those 4 are, to me, very useful today. The one that unfortunately is not useful is, learning how to manage people and get the most, having a team and trying to find, the way to get the most out of them. My thing was always find how people can contribute. And so, there's always a job that somebody can do. And you define the job, you set people up for success, and you find the job that private or specialist that he can do. If it's just carry a radio, have them carry the radio, but make sure as many people are on board, part of the mission as possible, because that really helps esprit de corps. And then, like I said, set people up for success. A big part of leadership, as I saw it as a lieutenant, as a platoon leader, was matching the personnel to the responsibility. So your best soldiers, your best sergeants, they get the hardest assignments, and vice versa. Everybody's got a job, everybody's involved. And if somebody's a really, if they're just not on board, they won't play ball. You try to, if you can't get rid of them, you just try to minimize them, have them go, pull maintenance back in the motor pool. But unfortunately, I don't have any subordinates right now. So yeah, that aspect, unfortunately, maybe someday it'll become useful again.
Could be
But the other three aspects, what's that?
Could be your kids down the road.
No, I don't have any children, so I don't know. Maybe my nephew. but the other three components of military background I found very useful, or I find useful. One is the importance of military history in military training. I mean, I feel like I said earlier, the first book I read about finance was The Great Crash from 1929. And I find, and I started reading financial history from there on back. So I've seen everything from, I've read everything from tulips all the way up to now. And I think that's a real advantage I see right now in the marketplace. I think I think some people almost make a virtue of not knowing anything that came before, because they say, well, this is a new era, and okay, boomer, and everything you know is irrelevant. And that can be farther from the truth, because people psychologically have not changed probably since the Ice Age, right? I mean, the human psyche is not evolved, for probably thousands of years. So the way, people react in certain situations, there's a lot that's from the past that informs how people will react today. So, as it is with military technology, yes, I mean, the tools and the weaponry change over time, but the basic principles, the basic way people have conducted themselves throughout history, whether it be, military operations or finance, it hasn't, the tools have changed, the weapons have changed, but the basic human makeup behind it hasn't. So, military history is a big deal at West Point. I think they do a really good job of giving people that context. So that's huge. And if I recommend, people contact me on LinkedIn, say, well, what should I do? I'm interested in getting involved in finance. I said, you just got to start reading. I mean, always be reading a book. Always have a book you're reading on finance or economics, business, something in the field that's going to make you smarter. So the second thing that has good applicability is the idea of when you want to achieve an objective, obviously you have to identify where you want to go, what you want to achieve, but then you have to say, well, what are my resources? So as a platoon leader, the resources would be, I have these troops, these equipment, we have these tactics, so if I say, well, I want to get into selling, if I want to get into short selling, okay, before you do it, you have to take an inventory, of what your skill sets are, what your capital is, what types of instruments are you familiar with trading, do you have experience with? And if you can't get from, those given to the objective, you have to say, okay, well, how can I improve upon, improve upon my tactics, increase proficiency with new weapons. I mean, so basically it's kind of a systematic thought process from what you have available, and then building the plan to get where you want to go. It's it's not something, not being haphazard about it. I mean, just saying, well, I'm gonna start selling short and I'll pick something I don't like, and you're gonna get destroyed. All right, so just being very conscious of what the objective is, what your resources are, and what your tactics, what your knowledge set is, to get from what you have and where you want to go. So that systematic thought process, and And the third thing is like, don't panic. I mean, panicking never makes anything better. I mean, it never, ever makes anything better. I mean, so, you know, oh, you always got to keep your cool. Yes, because I've just heard people just completely melt down, and everything descends into chaos. And once people start screaming,
Yeah,
it's over. You know, so yeah, you gotta. Yeah, I've been in some hairy situations trading wise, and I also, in addition to the long only money management business, you know, I work with in the family. We also, I have, along with a West Point classmate, we have a proprietary trading company. And, you know, one time we were in a hairy situation in a short kind of a short squeeze setup. And my buddy called me and said, well, man, what's going on? Like, what are we going to do? I was like, don't worry. Like, I got it. You know, I mean, hey, you know, I mean, just, you had to take off some risk, you know, lock in some loss. It's painful to do, but, you know, I mean, you just
keep it fucking cool.
Yeah, you just have to stay calm.
Yeah, that's so interesting, because like everything that you mentioned there is exactly what like a retail investor doesn't have. They don't have patience. They want that quick fix. They don't have their cool, and they don't have a systematic process. You know, like literally looking at it from top down or bottom up approach often falls through the cracks, and people are inherently not researching as much. You know, like the typical meme is like, look at chart, price goes up, I'm going to buy up, you know. And that's where all the experience that you have like had, and which brings in other aspects of life, is very applicable, and it's obviously stood in good condition for you.
Yeah, yes, like not having patience, not having a plan, and then not being, like I said earlier, like being completely ignorant of history, and almost, like I said, to the point of being dismissive of history. To me, I think that point is the one I find this the most kind of bizarre. Yeah, I'm not surprised. You know, people have never had patience. You know, people, you know, almost never have a plan. But it's like this hostility to, you know, to knowledge is just bizarre. I mean, I think I think that reflex probably comes from, you know, people want to think that, you know, in the current context of, you know, this is something we've never seen before. This is my opportunity. I'm going to get involved. It's going to make me rich. And, you know, if I say, well, we've been in situations like this, you know, I came of age during the dot-com bubble. So I saw, you know, a lot of what you saw in dot-com, you're seeing now, you know, with meme stonks and crypto. Like I said, people haven't changed, just the specifics change. And I say, well, no, this has happened before. Yeah, I know it's happened earlier in history. And there are other, you know, like I said, there was tulips, South Sea Bubble, Mississippi Company, you know, canals, railways. I mean, it just, you know, it goes. So, and I tell them this, like, they're like, no, man, you don't get it. You know, like, no. I mean, because they don't want to hear it. They don't want to hear that, no, this isn't, no, you're not going to be rich. This isn't, this isn't your ticket. You know, I mean, so I don't know. I mean, yeah, I find that part to be kind of the most kind of troubling. I don't know, the dismissive, almost like hostility people have towards it. It's just, I don't know.
It makes a lot of sense, because people focus on, as you said, the specifics. So it's like, oh, this one is different. We're in a situation now that has never been there before, or whatever. Yeah. Whereas like the fundamentals underneath it are things that have been robust. It's cyclical, and that's what human nature and behavior often is.
Yeah, I mean, the we've never seen it before. I mean, that's almost always at the heart of a mania. So even with tulips, like tulips came from like Southwest Asia or, you know, Eastern Mediterranean. They came to Holland. They're like, we never seen these before. These are incredible. These are the most beautiful flowers we've ever seen. It's like, you know, so it's something new and something exotic, and it took off from there. You know, and the South Sea Bubble was this big British 1720 mania that even sucked in Isaac Newton. And he said, I think a quote he had was, I can predict the movement of the heavens, but I can't predict the madness of crowds. I think he said something along those lines. But at any rate, South Sea bubble was about trade with the New World. So that was, trade with South America. We've never seen it like this. It's going to change everything. So like I said, canals, railways, radio. I mean, so it's always something new. So that hasn't changed. But what also doesn't change is what creates value. And ultimately, it's in my opinion, it's the ability to produce goods and services that are valued by society and an economy. And the new thing, you can't go from there and tie it back into, well, how is this specifically going to add economic value in a way that produces profit? If you can't get back to that anywhere near that determination of value, you're probably in a mania, and it's just not going to end well, because it never has before. So yeah, I mean, go ahead.
That makes a lot of sense as well, but I'm trying to think in terms of like that bubble mentality. So if it's there to create value, what if there's a situation whereby some things do create value? Like, let's say, I don't know, the way like equities are going at the moment, you have this proportion of like stonks essentially, but then you also have a portion of equities that are providing value. Let's say Apple is, or whatever, but then they are also highly overvalued, or they could be overvalued. Some other examples.
Yeah, I mean, I would, I would put, I'm talking about, the bubble dynamic I was describing. I put more of the, obviously crypto, Tesla, a lot of the stuff that Catherine Wood, the disruptive innovation type plays. A lot of that, a lot of that is, it's all pie in the sky, and there is, it sounds great, it sounds sexy, exciting, but there is no real serious effort to try to tie it back to, well, how much money is this stuff going to make? And there is no, she has models and maybe 5 years this and that, but I mean, it's flim flam. It's 90% hype. But I would say that's distinct from, what you would see, with an Apple or Google, Microsoft. I mean, those are legit, high-powered, extremely valuable, productive companies. But, they still can be overvalued, to your point. And I think they are. But I wouldn't say they're in a bubble, because they're, I think there are people who are buying and selling them are doing, they're making an attempt at least to do a serious valuation. And, I personally think they've gotten ahead of themselves, but I wouldn't say, they don't have a bubble mentality. I mean, I think that's, in spite of the fact that they are, I believe, to be overvalued at this point. They're great companies. They're legit. They're real, highly profitable, but everything has a price. And right now, they're overpriced. But I wouldn't say that isn't a, when you're in a bubble situation, you can lose 90% of your money. I mean, people think that's incredible. Like, no, you can't. You can lose 90% of your money.
Yeah.
I mean, are you lose 90% of your money in Microsoft or Apple? No. You might lose, you might lose 20 or 30, but you're not going to get cleaned out.
It's funny you said that, because my best mate that I live with, his dad, really smart guy, like 40, 50, but he was involved in .com bubble, and my mate was looking at his portfolio the other day, and he was still holding equities that have lost 80%. They were still in his portfolio from the .com bubble of companies that are still functioning, but they were functioning at like $50, and now they're literally like 4 or 8, and that's the mentality. That it's funny, because it doesn't matter if you're on your end or my end. It's like, when it goes 80%, of course it can in a regular market.
Yeah, I mean, I think a confusion people have is, it's something, just because something doesn't go bankrupt doesn't mean the stock has to go up. So you can look at a company, I think Cisco, for instance. I don't think Cisco I don't think it's made it back to its .com high. I think it might have gotten to like 70, and now it's maybe 53. It's don't get me wrong, it's a wonderful company that makes a ton of money, but they, you bought it at $70, back in 2000, you're still underwater,
100%. Yeah.
So I mean, just because somebody doesn't go bankrupt
Mhm.
doesn't mean you're going to make money if you buy it at the wrong price.
Mhm.
So even the big winners like Microsoft and Amazon, I think it took Microsoft 15 years to get back to its bubble peak. And I think that's just something people don't, so even if Tesla, hit $900 a share, I don't think you'll ever see that ever again personally, but even if it does, it could take 15 years. And I think tell that to people. You tell them you can lose 90%. It can take you 15 years to make your money back. And they look at you like you're crazy, but it's happened. It can happen again. Why can't
it? Exactly.
So,
especially on that point you're saying there, in referring to like rising bond yields or rising inflation and money leaving the S&P or leaving equities, do you think these like high growth stocks, speculative stocks like Tesla are kind of the ones that are going to be hit the hardest? Or especially, your traditional Chinese growth stocks. So they've just got these crazy growths last year, 200, 300, 400%.
yeah.
Now, do you see this like huge correction because of a combination of yields and inflation, among other things, or people just getting their head around it? Because, sorry to interrupt you, but basically, like, back last year, everyone was like, you'd be stupid not to put your money into tech stocks. And now this year, it's like, you would be stupid because we're at this point where it's the breaking point,
I think right now the most powerful dynamic in markets is inflation expectations and interest rates. Because right now, the stock market in the US, I can't speak as much to China, but in the US, it's on an absolute basis, it's the most expensive it's been since the dot-com bubble. And relative to interest rates, it's the most expensive it's been prior to the financial crisis. So given where the valuation is, this market could not take a higher level of interest rate. When you it's priced so high that if rates I think if the 10-year treasury yield now it's a 1.64%. If they were to get to 2, I think there would be a major readjustment of valuations. And in that scenario, it's not necessarily my prediction, it's definitely a risk because there's this big battle of, yes, we're seeing inflation, but is it going to just transitory, just last for a year, then we'll go back to where we were, or no, is it going to permanently change expectations and it's going to have legs and it'll go beyond 2021 into 2022. But given where the valuations are today, if that argument goes towards more inflation, higher interest rates, I think, like I said, this market will suffer a fairly sizable correction, if not an outright bear market. And in that scenario, the bubble stuff will just get absolutely annihilated. I mean, so yeah, I think Tesla, I think it's closed today, it's around 550. Yeah, I think below 200 is possible. I think Bitcoin could go under $10,000. I mean, yeah, it'd be really ugly for the bubble stuff. The FANG man, high quality growth. I mean, there's risk there. It's not that kind of apocalyptic risk, but they could lose, like I said, 20 to 30%. And then the generalized stock market, I could see lose 15 to 20. So if I'm keying off anything, it's inflation expectations and the 10-year treasury yield. I mean, I think that, we saw that last week where, there was a big beat in the inflation expectations in the US, 4.2 versus 3.6% inflation. And I mean, when that print just devastated the NASDAQ, so yeah. I think that's basically a taste of what you would see, if we saw more of that going later into the summer. So
My kind of question off that would be like, where does smart money go next? So like probably a better question is like, how do you protect yourself? How do you protect your portfolio in times of rising inflation and yields? Like, is it a move towards like financials, like defensive stocks? Like, what actually would be your approach of something like this? Not investment advice, but what's the actual, bear market approach, or I don't know, one way to protect yourself?
well, I mean, I advise anybody who owns any of those bubble assets, like I said, the ARK ETFs, Teslas, crypto. I mean, take the money and run. That's what I'd say. Yeah, get out of that. If you're overweight, if you're overweight the big tech names, cut back. And they're great companies, so I wouldn't say, oh, you got to get out of them, run. The way I would with a Tesla. But if I definitely would pull back exposure from where you're at. And as far as value stocks, in a rising rate environment, value is going to do better. I mean, there's still risk in them, but not nearly the extent as growth. So and so you can maintain a presence in the value side, and there's nothing wrong with having cash, because cash earns nothing, and you wouldn't want to hold it for 5 years, but if things are really running hot on the high side valuation wise, and in tech, and there is a substantial risk of a decline, having some cash ready to buy later in the year would not be the worst thing in the world. So you don't have to be fully invested all the time. You don't have to say, I'm going to inflation proof my portfolio and get 100% invested in commodities and value stocks or whatever. It's like you can just take some of the, to the extent you can cash out some of that high flyer stuff you had and you made money, great. Like you don't need to reinvest it. If you take some off of your Google or your Amazon, you don't have to reinvest it immediately. And so that would, if you're looking to be tactical and active, you don't have to always be invested all the time.
Yeah. And that's what people kind of, even myself, I always kind of felt like you kind of have to be invested in different areas. But like it's funny enough because as you mentioned, the big kind of boys, like I did rebalance off Apple because I was a bit more exposed and possibly I should be, just kind of a bit of these concerns going on. So I did just literally rebalance a small, but obviously my portfolio is nothing on the scales of some of the people that even would be listening or actual big just big actual investors. But it's interesting to see that kind of move. But you also mentioned commodities, and funnily enough, my mate was mentioning this the other day as well. Even with like this, silver super cycle apparently that's on the way, or even with gold, do you think that would be like a better approach, or traditionally commodities are like a hedge? Do you think that would be a good idea, or do you think there's still that kind of risk across the board?
Actually investing in commodities is much more difficult than it sounds, because like with the exception of gold and probably silver via exchange traded funds, they actually hold the physical commodity. Typically you have to invest through futures markets, but that always complicates things, because in futures markets there's something called the curve, the calendar curve. And so when you buy, oil, a future, you buy it from, out to October of this year. The problem is typically you buy that future is trading what they call contango. That's a term you hear in commodities. And when a futures market is in contango, that means the farther out futures are at a higher price than the commodity is trading at physical today. So you can say, well, I think oil is going to go up. Oil might be like $60 a barrel right now. I'm not exactly sure, but if you invest in oil futures, you have to go buy it at 70. So in order for you to actually make money, oil would have, by the time your futures contract comes in, oil would have to appreciate to 70. So typically when you invest in commodity futures, you constantly have this, you're buying farther out at a premium. So that is typically a very big headwind, and it makes investing in commodities a lot more difficult and less profitable than people think. I mean, it's like the big time commodity traders is what they'll do is they'll rent a super tanker. If they want to buy oil, they'll park it, park oil in the super tanker, then they'll sell, they'll buy the physical at 60, put it in the super tanker, and then sell the futures at, in October at 70, and they lock in, that $10 spread net of their, whatever they got to pay to rent the tanker and whatnot. And that's how they trade. Small investor doesn't have the ability to, play that game. So when people say, "Oh, you want to move into commodities," it's a lot more complicated than it sounds. A lot of the exchange traded products that retail investors have access to, they are based on derivatives, and they have that constant headwind of contango to deal with. So it sounds good, but I don't suggest people play that route for the reasons I give. I mean, you look at GLD in the U.S. is the big gold ETF. They actually hold physical gold, so you don't have to deal with that. That futures dynamic. But I mean, I can see this in this situation. Having some gold wouldn't be the worst thing in the world, but I wouldn't necessarily think it's a sure thing to pay off in a inflationary environment. I mean, I don't think it's. I don't think it's like, well, I'm gonna put all my money, because I hear people say, well, I'm putting all my money in gold and I'm gonna kill it. Like, I don't. It doesn't necessarily have to. Yeah. It may not pan out that way. It makes sense to have some, but I wouldn't put all my hopes in it for sure.
Exactly. And that's the exposure element of it as well.
I guess from the takeaway from that discussion is you don't have to be fully invested all the time. If you sell something, you don't need to invest. You don't have to automatically put it to work. It doesn't have to. It's very cliche what Warren Buffett says. It's like in the sport in America, we have baseball, and I guess it's like cricket. I don't know the rules of cricket, but in baseball, the pitcher throws to the batter. The batter doesn't have to swing if he doesn't like it. And that's how he describes investing. You don't have to swing until you see something that comes down the middle. You don't have to swing at every pitch. So. Yeah, that's this compulsion to always get involved and always trade. I mean, that's not the way it has to be. Nobody's forcing you to do that.
Especially when it comes to Warren Buffett, it's best to watch what he does and listen to what he says, and kind of watch that kind of closely. So that's where it's an interesting kind of relationship between there as well.
I mean, he's built up a massive amount of cash. In his case, it's been a drag on his returns. I mean, I'm not suggesting that holding cash is a winner long term, but if you're looking to be a more active investor, carrying some cash to take advantage of opportunities farther down the road is not, on a tactical basis, there's nothing wrong with that.
Makes a lot of sense.
Yeah.
The last area that I want to discuss, I want to give a bit of time to, was all around crypto and Bitcoin. And especially spoke there about not overextending yourself. Traditionally, people would be overly extended heavily in the crypto space. So it could be some shitcoins, it could be Bitcoin, but basically most people's exposure is 100%, or it's diversified across crypto, which means there is no diversification because everything is tied back to Bitcoin. Correlated anyway. If you were to calculate the correlation across it. So I want to get your thoughts on really the fundamentals. So as you're speaking about the lack of fundamentals, but if you think there is some sort of fundamentals in other aspects of it, so if it is Ethereum or possibly a fork of Ethereum down the road, do you think there's some sort of value in that versus what's happening there at the moment, or your perspective in general?
The one I've looked at most closely is Bitcoin, and I know less about Ether, which is, some people say it's the silver to Bitcoin's gold. I understand that the Ether blockchain actually can run these smart contracts they talk about, and I don't know enough about it to say how I can somehow go from the price of Ether, the cryptocurrency, and see what value is derived from the utility of the Ether blockchain. So, I mean, there might be something there. I honestly, I'm not going to say I have the technical proficiency to know what that is. I mean, based on the way Ether acts, I mean, it seems extremely speculative. A lot of the price action probably has nothing to do with the what people are doing on the blockchain. You know, so I'm not, like I said, I'm not sure exactly how they tie in each other using the blockchain for smart contracts and the value of the Ether cryptocurrency. There might be something there. I don't know. It looks extremely speculative to me. I wouldn't touch it. The Bitcoin, on the other hand, the Bitcoin blockchain is only used to trade Bitcoin. So there is no smart contract, aspect that somehow you can argue gives Bitcoin value. I mean, Bitcoin is ultimately I think it's a pyramid scheme. And the reason I say that is that the only way to make money in Bitcoin is to sell it to another speculator at a higher price. Mm-hmm. And that, so new money pays out old money. That is, by definition, a pyramid scheme. There's no other way to make money in Bitcoin. I mean, you have to sell it to another speculator because there is no commercial user. I mean, there's no, you can buy oil and you can sell it to, sell the contract to an oil refiner. He's not a speculator, he's a commercial user. There are no commercial users of Bitcoin. It's not part of any industrial process.
It's not a unit of transaction. People aren't actually using it in a free. It's not being used as a unit of transaction. Like people have been using it online for dark web shit, but it's not actively used in terms.
Well, I mean, it can be used as a means of exchange, but the only reason it has any value to execute that isn't by the fact that it's, the value which allows people to use it as a means of exchange is predicated on the fact that you might be able to sell it to somebody else at a higher price. So as long as people have that the value that's imputed to it is that of the greater fool theory. I mean, it has a greater fool theory pyramid dynamic value, which is that allows the dark web people to transact value with it.
Yeah.
But that the point is the basis of that value is greater fool. And I can't think of any time in history that kind of dynamic has been sustained. I mean, so in my mind, Bitcoin has a very good chance of going to zero. I mean, because I don't, ultimately, if that's all is there, is the hope that somebody else will buy it for me at a higher price. That just can't, it's only a matter of time before that disappears. I mean, it's literally only a matter of time. Could happen, because it's already started happening today, but I don't think you're going to go, you're going to go a decade without that really hitting the skids. And people say, hey, it's been around 10 years. What are you talking about? It's been around for, since 2008, I believe, but it really didn't start heavily trading in 2011. Bitcoin has never seen a proper bear market in risk assets. And so its whole experience has been in the context of a raging bull market in stocks. I mean, you had the pullback last February. That wasn't a bear market. That was too brief to be a bear market. Bear markets last months and years. I mean, February 2020, March 2020, it was like 4 weeks.
Yeah,
it wasn't long enough to change the risk psychology of investors. I mean, it wasn't. If anything, things popped. It popped back so quickly. I mean, not only did that movement make people more cautious, it kind of gave them more confidence to speculate even more aggressively. So Bitcoin has never, in its history, has never really seen a proper bear market like you saw 2000, 2002, 2007 to 2009, where it's not just a fall in price of risk assets, but it's a sustained sustain loss. When you hear people say, I don't want to look at my brokerage statement,
Yeah. Yeah.
that's, we haven't seen that, and Bitcoin hasn't seen that. So when it hits the skids in that kind of environment where people, they're not worried about making money, if they're worried about not losing money, I think it can be fatal at this point. So, but whether it's now or a decade from now, I just don't see a point where, that whole greater fool, I can sell to somebody else at a higher price. That confidence game can be indefinitely maintained. So,
especially when
I am very, obviously, I'm very, I'm very negative on Bitcoin. The larger crypto universe, like I said, I'm not going to give an opinion on that because I don't feel I have the technical, ability to make that judgment.
Mm-hmm.
I think I think DeFi, as I understand it, has a future. I don't think it's as revolutionary as people say it is. I trade stocks, futures, options on a traditional centralized exchange. If all that went on a blockchain, as an end user, would I really know or care? I mean, if I was trading on the CME or the Binance blockchain, I'm trading the option either way. Right now, it's seamless, it's cheap. I guess the beauty of doing a blockchain is that the trading costs will be that much lower. But so the point is, I think DeFi, it's real. Is it revolutionary? Is it the internet? Like I think it's a much more marginal improvement. So I don't see it being as revolutionary. And I think a lot of the hype surrounding it is the price of the cryptocurrencies. Mm-hmm. So people see the explosive price in cryptocurrency, and then say, well, DeFi must be huge. It's going to be, it's going to change the world. I mean, I think seems like more of a marginal improvement, but like I said, I'm not an expert in that by any stretch of the imagination, but from Bitcoin as a financial instrument makes no long-term sense, period.
Well, to be fair, you're playing both sides really well, as in you understand the technical, you don't understand the technical parts, so you're not, you don't have your opinion on that, but you're looking at it from a value and a fundamental perspective, and that's where your experience is really valuable in that area. So unlike on Bitcoin itself, I'm pretty much similar. So when it's driven by TikTok and driven by Twitter, there's a problem, where it's getting pumped by Elon Musk, or people are putting up all these shitty TikToks, so people trying to trade all these little shit coins, and that's where it's crazy. Because even people that I know that are crypto traders, they look at this and they're just like, what the fuck, and that's the problem with it. But one area that I want to chat about, well, several areas. Well, firstly is obviously Elon Musk's perspective on this, and that's where I kind of lost a lot of respect for Elon Musk recently, because electric cars going towards green energy, obviously that's a good thing. It's a good thing for the environment, good whatever. But when I started seeing a lot of this stuff and seeing these crazy price swings and just a change in opinion every 2 minutes, that's where I kind of lose a bit of respect for that stuff. So firstly, kind of on the store of value part, in terms of how can you store something that's valuable if it's changing 15% and influence?
No, you can't. The idea that something that can move 15% in a matter of minutes based on a tweet is a store of value, that is so patently ridiculous that anybody who, I think at this point, anybody would say, oh, if you want to own gold, you want to own not gold, I'm sorry, you want to own Bitcoin because it's a store of value. I'd say you're full of shit. I mean, you're either delusional or you're selling, you're trying to sell me something. I mean, that's just not a 15% move in 5 minutes on a tweet is not a credible attribute for a store of value. It isn't, period. So anybody who tells you that, they either don't know what the hell they're talking about, or they're trying to sell you Bitcoin. So this is what it is. I mean, there's no way to sugarcoat that.
Yeah, of course. So, and that's where on the retail side, to the retail investor side, I completely I'm aligned in terms of they need someone to come in to buy that at a higher price for you to make your 10-20%. But a good area to discuss about it is around people saying investors, so big institutions get involved. So we all heard about Goldman opening up their book, their prop trading desk, or not their prop trading desk, their client trading
It's not a
desk.
prop trading desk, no.
Yeah, sorry, their clients, so their clients can trade
Yeah.
Bitcoin. But obviously, like, they're doing it from the perspective of they're trying to make money off anything,
Oh
so,
yeah, I mean, the people, whenever I hear, when people say, oh, well, Goldman, Morgan Stanley, JP Morgan, they're going to start, selling Bitcoin to their customers. Like, that's Wall Street. I mean, they're in the business of selling customers what they want. I mean, if their customers want to trade Bitcoin, Goldman will say, fine, we'll sell it to you. It doesn't mean Goldman likes Bitcoin. I mean, I'd say, like, ask a crack dealer what they think about crack. They think it's a good product? Probably not. Do they care? No. Why? Because there's demand for it. So, I mean, so yeah, just because Goldman is selling you something doesn't mean Goldman likes it. I mean, there was maybe about 5 or 6 years ago, there was he was an associate at Goldman, and he left, and he wrote this New York Times column about why he left, and he said that Goldman would call their customers Muppets. I mean, that was kind of a big, revelation. That they're playing their customers for fools. They probably are. I mean, point is, just because Goldman's selling it to you, it doesn't mean Goldman likes it. That's just the business they're in.
Yeah, they'll sell anything as long as they can make it a profit off it.
Yeah, exactly. So. I mean, I guess as long as it's not blatantly illegal, they'll do it. Of
course.
And they'll probably push the limit on that, like they did with a lot of the subprime stuff.
Exactly. Sorry, that's
right. I mean, one thing I tell people, they say, oh, institutions are getting involved. Like, institutions were up to their eyeballs in subprime. I mean, institutions are more than capable of blowing themselves to smithereens.
Yeah.
I mean, so, I haven't heard any good argument for it yet. That can get beyond that hurdle of trying to give any other way to make money off it besides greater fool, higher price.
Yeah.
I mean, ultimately, that's what it comes down to, and there's no way you put lipstick on that pig.
Mm-hmm. So the last argument that I wanted to raise was around adoption by just large companies. So large companies investing in it, whether it be, I don't know, like your FANGs opening up a proportion of their exposure towards Bitcoin and leaving it in there as a long-term investment. What's your thoughts on something like that?
I don't think it's going to happen, and it's less likely to happen after what we've seen.
Which is price movements.
I mean, if I'm a corporate treasurer, corporate reserves they're supposed to maintain security of the company's cash. It has to be liquid so it can be accessed. Making money is tertiary. It's almost a distant concern. Security and liquidity are the two most important factors that corporate treasurers look at. The security, of Bitcoin is ridiculous. It's not. You're not protecting anything. You're taking a wild speculation. It's probably not that liquid. I mean, I saw a Bank of America piece on its liquidity that like a $90 million order in Bitcoin would move the price 1%. $90 million for a General Electric is not a large amount of money. I mean, so the liquidity of Bitcoin is it's not treasury bills, that's for sure. It's not even gold. I mean, and then it's, as far as is it going to make money? I mean, that's not what corporate cash is about. So
that's not what the Treasury Department do, is try to make money with their money, like it's T-bills, 30-year.
Well, I mean, if they can make money, that's great. But that's not. It's not a profit center. And cash reserves are not how companies make their money. Companies make money by producing a good and service and selling at a profit. I mean, their cash reserves aren't hedge funds. I mean, so they can get some incremental return off of it. That's great, but that's not why they exist. I mean, I think when Musk bought the 1.5 billion. I think it just got people talking about it, but I don't think there was ever really serious consideration. And after what we've seen in the last 2 weeks, I think people are like, hell no. I mean, that's not, basically what I said, security, liquidity, it's not there. Definitely not the security. So I don't think that's the whole adoption thing. That's just something that you hear from the Winklevi and, the Winklevoss twins and the Michael Novogratz and, people who are in the business of trying to sell you Bitcoin. So they flag this idea of it's going to be adopted, institutions are getting involved. It's all bullshit. So yeah.
Yeah, I completely agree. Like I agree as well. And from a corporate treasury perspective, in terms of like their idea is to maintain their cash, is not to be like, as in like, if they can make 30% or can make 5% or can make 2%, but if the downside risk is losing,
if they can get a little return, that's great, but that's not what corporate cash is about. I have never heard earnings call or read a report where the answer is like, well, how much are you making on your cash? They want to know, what are your profit margins? What are your sales growth looking like? They don't ask about, well, how many bips you making off your cash? That's not.
Not baked into that.
Yeah, it's just not how that's not real. No, it's not real. That's not how it works. So it's fantasy, it's hype, I think it's absurd. It's fascinating to see. But I think it's going to end, for anybody who owns a lot of it, it could end in a complete disaster. So
you're still short Bitcoin?
I'm not actually short Bitcoin, the coin. I'm short MicroStrategy, which is, you familiar with Michael Saylor? He claims to be the guy who talked Musk into doing his Bitcoin purchase. Saylor, basically, MicroStrategy is this company he started back in like 1999. It was a big story in it was a big .com stock. He became, a bazillionaire. Then he settled the SEC for securities fraud. That's a stock that lost like 99% of its value. Mediocre software product, declining revenues, not making money. The company was dying. So what he did is he put all his money, all their cash in Bitcoin last September, right before it took off. And then he started borrowing money to buy more Bitcoin. And he spends all his time just evangelizing Bitcoin, doing, media appearances. And it's just, so he's kind of a proven con man. And now he's gotten into this whole, check out his Twitter feed, anybody. It's Michael Saylor. The stuff he says, he talks about, one of his quotes is that Bitcoin are cyber hornets feeding on energy, the goddess of wisdom and the fires of truth. It's just absolute gobbledygook. So this guy staked his whole company on Bitcoin. I'm short that. I think he's probably going to go bankrupt. And then there's a couple of Bitcoin miners that trade in America. One's called Marathon Digital. The other one's Riot Blockchain. And you look at these companies, it takes you 15 minutes to look at their financials. 0 cents, make no money. I think there is no, Bitcoin would have to go into the hundreds of thousands of dollars before they would show a profit. Obviously stocks, you look at their charts, obviously blew up based on retail speculation. They've come off the boil. They're down already, they're down 60, 70%. And I think they could probably fall another 60 and 70% from here. So I'm not straight short Bitcoin, but I'm short Bitcoin related equities. Mm-hmm. Yeah. And I think there's a lot more to, MicroStrategy got like 1,300. Now it's like 5. It's like 580. So it's almost, it's got cut in half. The other ones I said are down 60 or 70. So yeah, I think the bloom's off the rose of these things, and the souffle doesn't rise twice. So I think they're toast, but that's the way I played it. Yeah, I'm a stock guy, so I usually, if I want to express an opinion in something, I'll usually do it via the equity market.
Of course, of course.
But
Daniel, I'd like to say a massive thank you. Really appreciate all your advice and all your feedback and wisdom. I could easily keep on going for another hour, but I think it's time
I
to,
appreciate it.
time to cut it. But I know I really appreciate everything though, and I like the fact that like you have your opinion, you have your thoughts, but then you also know like what you don't know, which is a technical side of it, whatever. So you're looking at it from a fundamental perspective, which is like the way you should be doing it. So
Yeah, I mean,
I appreciate your
that's,
perspective.
yeah, you got to know what you don't know. And unfortunately, the reality of a retail investor is you don't know pretty much anything. So it's like I said, read. It's not exciting, it's not sexy, but I tell you what, you read for 5-10 years, you're going to be way ahead of everybody.
Mhm.
If you're only 25, you got a long runway ahead of you. So there's no rush. There's plenty of time to make money. Okay,
Yeah.
so you gotta do it right. And there's no shortcut. So
Perfect.